Stop what you're doing for a second. Because while everyone's distracted by stock tickers, crypto memes, and flashy market news, something far more important just happened in one of the quietest corners of global finance. Japan, the country that spent decades treating interest rates like a historical artifact, has finally started paying real yields again. And that might sound boring, until you realize Japan wasn't just another market. It was the cheapest money source on the entire planet. For years, if you wanted funding that felt almost free, you went to Japan. You borrowed yen, bought literally everything else, and let the difference do the work for you. Stocks, real estate, venture capital, even your crypto portfolio. An enormous chunk of the global asset boom was quietly leaning on that single foundation. And now, that foundation is starting to crack. Here's the part that should make you a little uncomfortable. A Japanese 10-year bond paying a little over 1%, or a 30-year pushing toward 2%, doesn't look dramatic if you're used to American markets. But Japan isn't the US. In fact, it's the complete opposite. In Japan, a move like this isn't a small adjustment. It's a fundamental stress test on the entire system. And when the cheapest source of funding in the world starts changing its rules, the impact doesn't stay local. It travels silently through balance sheets, through leverage, and through liquidity in ways that never make headlines. Until suddenly, they're the only headline that matters. It sounds exaggerated, I know, but once you start following the financial plumbing, it starts to make some very uncomfortable sense. This story isn't really about predicting a crash. It's about understanding how the price of money is changing in the one place that quietly anchored global funding for a generation. When Japan starts paying meaningful yields at home, the world doesn't just get a new data point. It gets a profound shift in incentives. And incentives, not headlines, are what truly move capital. At its core, this is a story about the bond market as the funding market. See, bonds aren't just investments. They are the price of money. They are the collateral sitting beneath trillions in leverage, and they are the glue holding financial balance sheets together. When that price moves in the wrong place, at the wrong time, with too much debt already in the system, assets don't reprice gently. They reprice mechanically, and often violently. That's the lens we need to use here. And here's the part most financial coverage just skips over, because it's harder to explain than a simple price chart. Japan isn't just another economy reacting to interest rates. Japan is a creditor nation. For decades, it has been one of the world's largest exporters of savings, quietly sending its capital all over the globe because there was absolutely no return to be earned at home. Think of Japan as the world's vault. When yields in Japan were stuck near zero, its major institutions had no real choice. We're talking about massive pension funds, insurance companies, and banks. They had to go hunting for returns overseas. They bought foreign bonds. They bought foreign stocks. They bought huge amounts of U.S. treasuries. They bought the exact same liquid, safe assets that sit underneath global portfolios everywhere. That constant outward flow of money became a reliable tailwind for global markets, even if most investors never even noticed it was happening. Now, let's look at what changes when yields at home start to rise. The entire equation flips on its head. Suddenly, these same Japanese institutions can earn a meaningful return in their own currency, without taking on foreign exchange risk, without dealing with geopolitical noise, and without worrying about liquidity. At that point, sending money abroad stops being a necessity and starts becoming a choice that looks less and less attractive. And when incentives flip, behavior always follows. This is where people misunderstand what money coming home actually means. This process of repatriation doesn't tiptoe. It doesn't politely rebalance 1% at a time. It pulls liquidity out of whatever it touches. Those assets that benefited from years of steady, quiet inflows from Japan suddenly face the exact opposite force: quiet, persistent selling. That's why this story matters so much, even if you've never owned a single Japanese bond in your life. The real risk isn't that Japan's economy slows down. The risk is that one of the largest and most stable sources of global capital no longer needs to feed the system the way it used to. Once you truly grasp that, the rest of the chain reaction becomes much easier to follow. To keep this from turning into a blur of financial jargon, let's use a simple mental map. Think of it less like a checklist and more like a river current that you floating along. It all starts in Tokyo, with Japanese government bond yields quietly lifting off levels that have defined an entire generation of finance. That move alone doesn't crash anything, but what it does do is change funding conditions. And funding conditions are where real market behavior begins. From there, the river splits into two powerful channels that flow at the same time. The first channel is repatriation. As yields at home become viable, Japanese institutions have a concrete reason to start bringing their money back. Not all at once, and not with a big press release, but steadily, through thousands of portfolio decisions that reduce foreign exposure day after day. The second channel is the unwinding of the carry trade. For years, borrowing yen for next to nothing and investing it elsewhere was one of the most popular trades in the world. As Japanese yields rise and the yen's behavior becomes more volatile, that trade becomes tighter, riskier, and eventually, completely unstable. Those who were in that trade have to get out. And here's where those two channels meet at the same critical pressure point: selling. But this isn't emotional, panic-driven selling. This is mechanical selling. It's balance sheets adjusting to new realities. It's risk managers stepping in and enforcing new rules. It's margin requirements suddenly rising. And when these massive funds need to raise cash, what do they sell? They sell what is liquid and what has worked best for them. That almost always means large-cap U.S. stocks, broad index exposure like the S&P 500, and other popular, crowded trades that many of us hold in our own portfolios. From there, the effects spill outward into the broader economy. Reduced foreign demand for U.S. debt starts to show up in treasury auctions. If demand softens, the U.S. has to offer higher interest rates to attract buyers. Those rising yields then tighten financial conditions for everyone. Mortgages become more expensive. Corporate borrowing gets harder. Credit markets seize up. At that stage, policymakers are dragged into the story, not by choice, but by absolute necessity. They are forced to react, and only then do headlines catch up. Currency risk jumps. At that point, the carry trade doesn't gently unwind. It gets squeezed. A squeezed trade has one universal outcome: liquidation. Not because investors suddenly change their minds, but because margin requirements change. Lenders demand more collateral. Risk models tighten. Positions that once looked fine become dangerous overnight. Funds reduce exposure because they have to become less profitable or outright risky. Funds start trimming exposure. Asset prices fall. Your economy with real manufacturing, deep savings, and institutions that think in decades, not quarters. The real story is the system that grew comfortable leaning on Japan as a permanent source of cheap money. For years, the global architecture assumed one thing would always be true: Japan would suppress yields, export capital, and quietly absorb the costs. That assumption shaped everything from equity valuations to how much leverage felt safe. When that assumption starts to wobble, the problem isn't Japan's outlook. It's the dependence everyone else built around it. This is why the current moment feels confusing. People keep asking, is this bullish or bearish? But that's the wrong frame. What's happening is neither a bullish catalyst nor a bearish trigger. It's a switch being flipped. A funding regime that once lubricated risk-taking is changing shape. That's also why this episode feels less cinematic than past crises. There's no single shock, no dramatic announcement, no overnight collapse. It's a mechanical adjustment driven by constraints. Currency pressure here, balance sheet math there, forcing policymakers and institutions toward less comfortable choices. The old Widowmaker label captured how dangerous it was to bet against Japanese bonds when the central bank could buy endlessly. But it quietly assumed there was infinite track ahead. Currency pressure shortens that track. Markets don't need to defeat the central bank outright. They only need to test the limits of what can be defended at once. Once you see this as a system-level shift, the behavior across markets starts to line up. Heavy rallies that stall, strength that fades, risk that feels fine one week and fragile the next. These aren't contradictions. They're symptoms of a structure adjusting to a new cost of money. And when structures adjust, they don't ask for permission. They respond to constraints. A simple way to hold this in your head is to picture global markets as a massive pool. For years, Japan was one of the main hoses filling it. Cheap yen funding kept the water level high, even as more people jumped in and more leverage piled on. The pool felt deep, safe, forgiving. Now the hose isn't blasting the way it used to, and a drain has quietly opened. At first, nothing looks wrong. The water level drops just a little. Most swimmers don't notice. Then the shallow end starts to feel strange. Footing gets uneven. Movements that once felt easy take more effort. Eventually, parts of the pool floor that were never meant to be exposed begin to show. Another way to see it is through the foundation of a building. Government bonds aren't just investments. They're the concrete slab underneath leverage. They're what gets pledged, rehypothecated, and treated as stable ground. When that slab shifts, even slightly, everything built on top starts to creak. The higher the floors, the more noticeable the movement. Neither of these metaphors implies collapse by default. They imply adjustment. But adjustments at the foundation level feel different from normal market noise. They change how risk behaves. They change which assets move first. And they change how forgiving the system is when something goes wrong. Once you recognize that the water level is falling, or that the foundation is shifting, you stop asking whether today's price move is good or bad. You start asking whether the structure was built to handle less liquidity. That question matters more than any single headline. This is where it's important to slow down and keep the language conditional, not prophetic. Nothing here says a crash is guaranteed. What it says is that the system's tolerance is thinner than it looks when debt is high and funding conditions change. If Japanese yields continue to drift higher, even modestly, the first pressure point isn't growth, it's funding. Higher yields signal tighter conditions for yen-based financing. If that happens while the yen also becomes more volatile or strengthens, the carry trade comes under increasing stress. Positions that once looked routine start to look risky, and risk managers don't wait for certainty. They reduce exposure. If repatriation accelerates, the effect won't announce itself with a press release. It will show up as persistent selling in foreign assets, especially the most liquid ones. That's not because those assets are bad, but because they are easiest to sell when balance sheets need repair. In that environment, rallies can fail even when the news flow looks supportive. If Japanese institutions reduce their participation in U.S. Treasury markets, whether by buying less or selling some holdings, Treasury auctions become more sensitive. Weaker demand doesn't mean immediate dysfunction, but it does mean yields have to do more work to clear supply. Higher yields then tighten financial conditions across the U.S. economy, touching mortgages, corporate borrowing, and bank balance sheets. And if tighter conditions begin to slow growth or threaten financial stability, policymakers face an old dilemma with fewer comfortable options. They can tolerate higher yields and accept economic pain, or they can intervene to stabilize markets by expanding balance sheets. Historically, systems with heavy debt loads struggle to tolerate prolonged high rates. None of this requires panic to unfold. It only requires incentives to keep shifting in the same direction. Markets don't break because people feel afraid. They strain because funding gets scarce and collateral values move against leverage. This is why small, boring signals like bond auction results or currency volatility can matter more than dramatic headlines. They tell you whether the system is absorbing stress or quietly passing it along. The takeaway isn't to predict an outcome. It's to recognize that the margin for error is narrower than it was when money was cheap and plentiful. In narrow margins, small moves carry bigger consequences. When a system is shifting, the most useful response isn't prediction, it's observation. You don't need to guess where markets will be next week. You need to know which signals tell you whether stress is building or being absorbed. This is how you stay oriented without panicking. The first place to watch is Japanese long-term bond yields, especially at the long end. Moves in the 10-year matter, but changes in the 30, understanding money, not guessing prices, subscribe and stick around. Crises rarely announce themselves with sirens. They start with quiet changes in places most people ignore. Japan is one of those places, and right now, the switches are moving.